Welcome to the deep dive. Today, we're zeroing in on the financials of two really interesting aviation companies, Archer Aviation and Joby Aviation.
Yeah, ACHR and JOBY. Lots of buzz around both.
Exactly. We've got some recent data here, market cap, share metrics, ownership stuff. And the goal really is just to give you, the learner, a quick handle on the key financial differences between them right now.
Not get too bogged down in the weeds, but see what the numbers might, suggest about their strategy.
Right. Are they taking similar paths or are these financials pointing somewhere different? Let's find out.
Okay.
So let's start with market capitalization. That's a big one. Archer Aviation, ACHR, it's sitting at 3.917 billion currently.
Which is pretty substantial.
It is, though interestingly, we're seeing some recent fluctuations, data points showing dips, -4, 500,000, even compared to an earlier 4.57 billion.
Yeah, those fluctuations are worth noting. It could signal maybe some market volatility or shifting sentiment around Archer specifically.
In Joby, the notes just say smaller market cap.
Right. So Archer is definitely bigger on that front, at least for now. A larger cap like Archer's might suggest, broader investor recognition or maybe a higher perceived value at this moment.
But the smaller tap for Joby isn't necessarily a negative.
Not at all. It could just mean they're at a different stage, maybe a more focused investor group, or simply haven't seen that same level of market run-up yet.
Okay, makes sense. Now let's shift to revenue per share. Here, Joby actually shows higher revenue per share, while Archer has lower revenue per share. That seems like a significant contrast.
It really is. Joby pulling in more revenue relative to each share, despite that smaller market cap. Well, it could mean they're maybe better at generating income right now from their current operations.
Or maybe just fewer shares outstanding.
That's possible too, yeah. It could be a factor. Or perhaps their models is just geared more towards immediate monetization.
In Archer's lower figure.
Might suggest more of a long game focus.
Yeah.
Maybe reinvesting heavily or prioritizing growth over immediate per share revenue. Different priorities, perhaps.
Got it. Okay, let's look at assets on paper. Book value per share. Archer has the higher book value per share. Joby's is lower.
Right. And book value, just as a quick reminder, is basically assets minus liabilities divided by the number of shares. It's like the company's net worth on the books.
So Archer having a higher number suggests more tangible assets built up.
Yeah.
Relative to debt and shares.
Generally, yes. It could indicate they've accumulated more physical assets or, equity over time. But it's important to remember, especially in tech or future-focused sectors like this, book value doesn't always capture the full picture. Intangibles, market potential is not always reflected there.
Good point. What about cash? Actual liquid assets. Here, the tables turn a bit. Joby holds higher total cash per share. Archer has lower total cash per share.
And cash. Well, cash is king, right?
It usually is. So what's the advantage for Joby there?
Flexibility, mostly. Having more cash per share gives them potentially more runway. They can fund R&D, scale up, handle unexpected costs, maybe without needing to raise more capital quite as soon.
And Archer's lower cash per share.
Could just mean they're deploying capital differently, maybe more aggressively investing it back into the business. Or it might suggest they're, perhaps closer to needing another funding round. It's something to watch.
Okay. And related to that is liabilities, debt. Archer shows slightly higher liabilities, relatively speaking. Joby has lower liabilities.
Yeah, and lower liabilities generally means a less leveraged position.
Less risky, potentially.
Often, yes. It can make a company seem a bit more financially stable or resilient, especially if, the economy gets shaky. Archers aren't necessarily high, but the difference is there.
And just looking at the overall asset picture, the source data visually shows Archer with a bigger total asset base.
Right, which lines up with that higher book value we mentioned. So while Joby has more cash per share, Archer seems to have more total assets overall on its balance sheet.
Interesting dynamics. Okay, last piece, ownership. Who holds the stock? Archer has a really high free float share, 75.09%.
Yeah, that's quite high.
Compared to Joby at 54.89%. And Joby is noted for strong, closely held ownership. What does that tell us?
So free float is the percentage of shares actually available for public trading on the open market. Archer's high free float means, lots of shares are out there, potentially leading to higher liquidity, easier to buy and sell.
And Joby's lower number, the closely held part.
That suggests a bigger chunk of Joby's shares are held by insiders, founders, major long-term investors, that sort of thing. This can sometimes mean maybe less day-to-day price volatility, but also fewer shares readily available for trading. Could indicate strong internal confidence, too.
Okay, so let's try to quickly sum this up for the learner. Archer, bigger market cap, more total assets on paper, higher book value per share, but lower revenue and cash per share, slightly higher liabilities, and more shares floating publicly.
That's a good snapshot.
Joby, smaller market cap, but higher revenue per share, higher cash per share, lower liabilities, and more ownership concentrated with insiders or core investors.
Yeah.
Exactly.
Yeah.
Pretty distinct financial profiles, aren't they? Even though they're in the same, exciting eVTOL space.
They really are. Which brings us to the final thought for you, the learner, as you do your own deep dive. Given these, well, quite different financial indicators we've just walked through, what kind of different strategies or maybe even risk appetites might Archer and Joby actually be pursuing as they try to build the future of aviation?
Yeah, something to definitely chew on as you watch this sector evolve.
Absolutely. Thanks for digging into this with us today.